The richest 1% of people on Earth own more wealth than the bottom 50% combined. Read that again. 1%. More than 50%. In 2026, the 8 wealthiest individuals on the planet own as much combined wealth as the bottom 4 billion people. This is not a political opinion. This is a mathematical fact. The question is not whether wealth inequality exists. The question is how it works, because understanding the mechanism is the first step to doing something about your own position within it. What is wealth inequality? Most people confuse income with wealth. They are not the same thing. Income is what flows into your life, your salary, your wages, your business revenue. Wealth is what you own, your assets, your investments, your property, your savings. You can have a high income and low wealth. A doctor earning a large salary who spends everything they earn has high income and zero wealth. You can have a low income and significant wealth. Someone who inherited a property portfolio earns little but owns much. Wealth compounds. Income generally does not. When you own assets, those assets generate returns. Those returns buy more assets. Those assets generate more returns. The more wealth you have, the faster wealth grows. The less wealth you have, the slower it grows, or it does not grow at all. This is the fundamental engine of wealth inequality. It is not primarily about how hard people work. It is about what they own. How does wealth actually accumulate? There are 3 primary engines of wealth accumulation. Understanding them is essential. The first engine is capital appreciation. When you own an asset, property, stocks, a business, that asset can grow in value over time. If you bought a house 20 years ago, it is likely worth significantly more than you paid. If you invested in a broad stock index 20 years ago, your investment has likely multiplied several times. You did not work for this growth. The asset worked for you while you slept. The second engine is passive income. Assets generate income without requiring your labor. Rental properties generate rent. Stocks generate dividends. Businesses generate profits for their owners. The more assets you own, the more passive income flows to you. The more passive income flows to you, the more assets you can buy. The cycle accelerates. The third engine is leverage. Wealthy people use other people's money to buy assets. They borrow at low interest rates. They buy assets that appreciate faster than the cost of borrowing. The gain goes to them. The risk is managed. The asset grows. Leverage multiplies wealth for those who already have collateral. It is largely unavailable to those who do not. Assets versus income, the key difference. Here is the single most important financial insight most people never receive. Trading your time for money has a ceiling. There are only 24 hours in a day. You can only work so many of them. Your income from labor is capped by the hours available to you. Asset income has no such ceiling. One property can generate rent while you sleep. 100 properties generate 100 times that rent while you sleep. 1 million shares generate dividends regardless of whether you are working or on holiday. The wealthy do not primarily earn their wealth. Their wealth earns wealth for them. This is why salary is the primary financial focus of most people and the secondary financial focus of wealthy people. Wealthy people focus primarily on asset accumulation. They sacrifice current consumption to buy assets. Those assets generate income. That income buys more assets. Over time, the gap between asset owners and non-owners widens automatically, not because one group works harder, because one group owns things that grow while sleeping. How the tax system helps the rich. Most people pay income tax at the highest rates they will ever face on the money they earn. Wealthy people pay capital gains tax, which is substantially lower in most countries. In the United States, the top income tax rate is approximately 37%. The top capital gains tax rate is approximately 20%. This means a nurse who works 12-hour shifts pays a higher percentage of her earnings in tax than a billionaire who made the same amount by selling stock. This is not an accident. It is policy. Wealthy people also benefit disproportionately from tax deductions, mortgage interest deductions, business expense deductions, depreciation allowances, research and development credits. These deductions are theoretically available to everyone, but you need wealth to access them. Wealthy people use tax structures, trusts, holding companies, foundations to reduce their tax exposure legally. These structures are expensive to set up and maintain. They are only economically rational at scale. They are beyond the reach of most ordinary workers. The result, a tax system that was designed to be progressive, taxes labor more heavily than capital, and almost all ordinary people earn primarily labor income, while almost all extremely wealthy people earn primarily capital income. Inheritance and generational wealth. A significant portion of extreme wealth is not built, it is received. Studies estimate that between 50 and 70% of wealth in developed economies is inherited or received as substantial gifts from family. This means the majority of the world's wealthy did not build their wealth from nothing. They received a starting advantage: property, investment accounts, business ownership, education funding that compounded over their lifetime. The children of wealthy parents receive advantages that are difficult to quantify fully: better schools, better networks, better access to opportunities, better financial knowledge passed down informally. A first-generation wealth builder starts at zero, sometimes below zero. A third-generation wealth holder starts decades ahead. The compounding nature of inherited advantage means that initial differences in starting position widen dramatically across generations. Inheritance tax exists to interrupt this cycle, but it is widely avoided by those with sufficient wealth to plan around it. Trusts, foundations, gifting during lifetime, family limited partnerships. The tools of inheritance tax avoidance are legal and widely used by those with access to specialist advisors. How corporations accelerate wealth. The modern corporation is one of the most powerful wealth accumulation vehicles ever created. When a company grows in value, the owners of its shares grow wealthy in proportion. Amazon was worth almost nothing in 1994. In 2026, it is worth over $1 trillion. The people who owned shares in the early years became extraordinarily wealthy, not primarily because they worked harder than others, but because they owned a piece of something that grew. Share-based compensation allows executives to accumulate enormous wealth while paying lower tax rates than ordinary employees. Stock options, restricted stock units, deferred compensation. These tools allow corporate executives to access hundreds of millions in income at capital gains rates rather than income tax rates. The ownership of corporations is highly concentrated. The wealthiest 10% of people own approximately 93% of all stocks. When the stock market rises, almost all the gains go to the already wealthy. When governments cut corporate taxes, the benefit flows primarily to shareholders who are disproportionately wealthy. Corporations also use their scale and legal resources to limit competition, protecting the profits that flow to their owners. The numbers: how bad is it really? Let us look at what the data actually shows. In 1980, the top 1% of earners in the United States received approximately 10% of all income. By 2026, that figure has risen to approximately 20%. In terms of wealth rather than income, the concentration is even more extreme. The top 1% own approximately 38% of all wealth in the United States. The bottom 50% own approximately 3%. Globally, the picture is similar. The World Inequality Database estimates that the top 10% of the global population holds approximately 76% of all global wealth. These numbers have been moving in the same direction toward greater concentration for approximately 4 decades. And the pace of concentration has accelerated since 2020. The pandemic was one of the most wealth-concentrating events in modern history. While ordinary workers lost jobs and income, asset prices surged, those who owned assets became wealthier. Those who depended on wages became more financially precarious. The wealth gap widened faster in 2020 and 2021 than in any comparable period since records began. What does this mean for you? Understanding wealth inequality is not about feeling angry, though the numbers may reasonably make you angry. It is about understanding the rules of the financial system as they actually exist, not as they are described in textbooks. The primary financial lesson from studying wealth inequality is this: income is not the path to wealth. Assets are. The most important financial decision you will make is not what job to take. It is how much of your income you convert into assets and how early you start. Even small amounts invested consistently in broad market index funds over 20 or 30 years compound into significant wealth. This is the same mechanism that the wealthy use, just at a smaller scale. You will not close the gap with a billionaire. That is not a realistic goal. But you can build meaningful wealth that generates passive income wealth. That reduces your dependence on trading your time for money. The second insight is that the tax system favors asset income over labor income. Understanding this helps you structure your finances to reduce unnecessary tax exposure legally. ESAs, pension contributions, capital gains allowances, tax-efficient investment structures. These exist and they work. The third insight is that generational wealth transfers compound over time. The most powerful gift you can give the next generation is not a lump sum. It is financial knowledge and the habit of asset accumulation started early. Understanding how wealth actually works is the most valuable financial education available. And now you have it. Let us bring everything together. Wealth and income are fundamentally different. Wealth accumulates through capital appreciation, passive income, and leverage. Assets grow while you sleep. Labor income does not. The tax system taxes labor income at higher rates than capital income. Significant wealth is inherited or received as advantage, not always built from nothing. Corporations are powerful wealth vehicles and their ownership is extremely concentrated. The wealth gap has widened continuously for 4 decades and accelerated dramatically after 2020. Your best response is to understand the system, convert income to assets as early as possible, use available tax-efficient structures, and prioritize financial knowledge. The wealthy did not write these rules for you, but nobody stops you from using them. This is not financial advice. Please consult a qualified financial professional before making any investment decisions. Check out other Broke Monkey videos for more financial topics explained simply and clearly. If you want to support this channel so we can keep making these videos, check out the link below. Apes Together Strong.